All right, David, I want to start with asking you a big picture question, and then we can kind of drill into the specifics of the bankruptcy that you have just emerged from in the new company. But let's start here. In today's world, if you were just dropped into today's media landscape with cable subscribers declining now for years and clearly the future of this industry being streaming, do regional sports networks make sense?
100%. I mean, listen, there's nothing more powerful, in my view, than a fan's connection to their local teams. I mean, I go back to my childhood. My dad was traveling all over the place. My best memories are going to games in Chicago with my dad. There's nothing that brings communities together than regional sports.
But what about the business of it? Like, I'm talking about you spend $30 a month on a regional sports network in streaming, and you're only spending $10 on Netflix.
Yeah, look, I think if you look at, particularly with the assets that I have, or that we have rather, excuse me, if you look at the fact that it's 12-month-a-year programming in the vast majority of our markets, and you're literally talking about, in some instances, 300 games for $20 a month, if that's the way that you want to consume local sports, then I think that's a deal.
Is there enough reach with that model, though, right? Because in the old world, in the cable world, you were getting your regional sports networks whether you watched them or not. So it made a lot of sense from the team perspective. It made sense from the network perspective. In the new world, only fans of the team are subscribing, and that's a much smaller pool. So does that part of it concern you at all for the future?
Listen, I think if you were to measure the markets that we operate in and throughout the United States, a high propensity of those markets are sports fans, right? So then if you kind of drill down a little bit, if you look at our individual markets, we have about 26 million subscribers that are part of the multi-channel bundle. There are over 20 million people that have access to our product directly. And so, look, I think that's a large pool to mine. And in addition to that, I don't accept that, hey, listen, everybody who's a sports fan is buying the multi-channel bundle. I mean, we have people who are buying the product directly from us at relative scale, early days.
All right, so let's rewind a little bit, because I think people that are even very knowledgeable about this industry may not know the ins and outs about what has happened to the artist formerly known as Diamond Sports, now Main Street, over the past few years. So I want to rewind. So you joined in 2022, right?
I joined the board in 2022.
Yep.
In March of 2022.
March of 2022. So let's rewind to 2018. 2018, Disney acquires Fox and divests what were the Fox Sports networks. There were 42 teams, I believe, at that point, integrated in what were the Fox regional sports networks. Sinclair buys these networks for about $10 billion in a highly levered deal, because the company was only worth, Sinclair was only worth, I don't know, $2 or $3 billion at the time. So they put on a lot of debt to acquire these networks. That deal goes south almost immediately, I feel. And because it was over-levered, this company eventually goes bankrupt. You are brought in before the bankruptcy happens. But when does it become clear to you that bankruptcy is going to be the ultimate option here? Is it when you're named CEO?
Yeah, it's in and around that time.
Which is a few months before they declare.
Yeah, so I moved into the job in early December of 2022. As I mentioned, I joined the board in March of 22. And, it was in and around that time when I started diving into the business, which was kind of slightly more before I moved into the CEO role. You could just look at the impact that the debt was having on the balance sheet and what we were facing in early 23 was a couple $100 million interest payment. And it was just kind of clear that the best alternative for the business in terms of trying to save the business was to file for Chapter 11.
You were at NBC when this deal went down, running NBC's regional sports networks. What did you think of the Sinclair purchase at the time?
You know, at the time, look, there were other bidders for the asset. And
not NBC.
No,
not Comcast.
No, not NBC. I mean, Comcast's view of the RSN business, and I think it kind of continues to be their view, is that it's an integrative solution whose roots tie back into Comcast cable. And so, you know, the measures of excitement at NBCU were really tethered to how Comcast cable thought about the business. And back when I joined Comcast NBCU in early 2016, it was a pretty good business that cable was still interested in being in, that actually spun off a lot of cash for Comcast NBCU, or in this instance, NBCU. And then if you kind of fast forward to Disney's divestiture, listen, there were other bidders. It's not like there was only one bidder, and Sinclair in that instance bought a landslide. There were some cover bids in the context of that, and it was still a business that was definitely generating a fair amount of EBITDA. I think as we kind of go into the Wayback Machine here, there were some events that happened shortly after Sinclair's acquisition, primarily as it relates to virtual MVPDs dropping the networks. And Hulu dropped, YouTube dropped, Fubo dropped. Like those are Dish dropped. Those are seismic events. Like, as you know, Alex, like the vast majority of the revenue for any cable network is in the subscription revenue.
Sure.
And when you have to face a significant impact on the subscription revenue, it's going to have a significant impact on the business.
Why did they drop? Didn't they drop because they felt like the math didn't add up anymore? It was too expensive for the amount of people watching?
I don't know. I mean, listen, particularly with a vertically integrated company, I mean, look, I played in the distribution space for over 20 years at the Walt Disney Company. And when you're running a portfolio, it's different than if you're kind of selling assets directly like we're doing today. And so it could be for a multitude of reasons, but most of them tie back to the financials of it all. But it may not necessarily be the financials of the assets in question, in this case, the RSNs. It may be the financials of an overall deal and how companies prioritize what assets they want to benefit from an overall exchange of value from a distributor in this instance.
Okay, so you come on board, you're CEO. It's fairly clear at that point that you're probably going to have to take this company through a bankruptcy. In the early stages, what did you think the bankruptcy was going to look like?
Yeah, we thought, listen, take a step back. For me, it was my first time through any bankruptcy in any role. And so there's obviously a fair amount of naivete that I brought into the situation. And, you know, early days, there was this feeling that, hey, we're going to get in and out of bankruptcy quickly. We're going to have a pre-pack where you kind of go in, check all the boxes, the judge approves our plan, and lo and behold, you're out of bankruptcy and you're operating in what they call a going concern. That obviously didn't happen.
So, again, briefly, can you go through the current ownership structure and the current recapitalization of the company? What does this company look like right now?
Yeah, so the current ownership structure is the largest owner of this business right now is Prudential. And then you have a bunch of financial institutions and hedge funds that own the balance of the company. Prudential owns about 35% of the company. From a capitalization standpoint, the company went from having about $9 billion of debt to $200 million of debt. So we've completely recapitalized the business.
And you mentioned the Amazon deal. Take us through sort of how that came to be, because there'd been a lot of reporting around it for a while. It seemed like they were in, maybe they were out, and then ultimately you guys did kind of emerge with a deal toward the end of the bankruptcy proceeding.
Yeah, so I think it came about in a couple of different ways. You know, one, as you know, Alex, this is a relationship business, right? And it's a small business in the end. And there's certain relationships as between advisors that we have and Amazon. And in addition to that, there's connective tissue. Like Amazon is an equity owner of Yes Network, another RSN. And we, Diamond, or the artist formerly known as Diamond, now Main Street Sports, own 20% of Yes Network. And so we would see people from Amazon at board meetings. And, you know, they just kept asking about kind of where we were in the process and whether or not there was any there. And, look, it was an integral part of our RSA back a year ago. And now things have changed a little bit, right? So Amazon was going to invest over $100 million in the business, and we were going to execute on a commercial deal. Yep. Now we're just going to execute on a commercial deal, and we'll be launching in the Amazon Prime Video store next month in a few weeks.
So just again, for people that aren't familiar, basically, if you are a Prime customer, you will pay a little bit more money, and then you will be able to watch your RSN games if you are in the region that your sport is being
played, exactly. Right? So you have to be in one of our markets. You have to be a Prime Video customer today, or a Prime customer, and have access to Prime Video. And then it's pretty simple. Like, you pull up your Prime Video app, and there's a button at the bottom, and it says subscribe. And you're going to be able to subscribe to us. It's completely seamless. It is going to be, for us, we think, by far the most efficient way to acquire subscribers on a direct basis.
Okay.
By far.
So, again, 2018, there's 42 teams wrapped up in these Fox Sports networks. Describe today, emerging from bankruptcy, how many teams you guys still have in which different leagues. And then, let's start there, and then I'll jump in with the next question. How many teams currently within Main Street Sports?
We have 29 teams. We added one yesterday, the Cincinnati Reds. We have 13 from the NBA. We now have 9 from Major League Baseball, and we have 8 from the NHL.
How did you decide these are the teams we want? Was it more the decision coming from you, or was it coming from the team or the league?
Well, I think it's both, right? So I think it's important, and this is important in the context of the process that we've been through. So, what bankruptcy affords you to do is to look at individual contracts, and you have, by and large, with the judge's consent, the ability to accept or reject those contracts. What we were then able to do is, if you kind of then fast forward a little bit past a year ago, we basically went to the distribution market to figure out what the art of the possible was with MVPDs. And we ran the table, but for Comcast, by the end of April. And so why is that important? In the end, just based on where the company sits, the value that you're able to extract from MVPDs basically dictates what you're able to pay teams. And so we had line of sight on that, and we were able to reconstitute our distribution agreements, which then gave us the ability to determine what we were able to pay teams. And so after that, we got taken off of Comcast, then we relaunched on Comcast in July, and then the month of August was spent on negotiating fast and furiously with the NBA and the NHL, because the season was going to start in October, and we were able to do that. And you had most of the teams staying in the portfolio, but you had a couple teams in each league exit the portfolio. And that was on their terms. We had what we could offer based on what we think we can compensate these teams. And they went in a different direction. So said a little bit differently, like, the portfolio that we have today, the vast majority of the teams are there because they want to be there. The only outliers are in the context of bankruptcy, and this was pretty well reported. You have the ability, as I mentioned, to accept and reject contracts. We were going to accept a few deals because we liked them.
And broadly speaking, I'm assuming now that these teams are now taking less money, correct, than they were?
It varies. Like, each team contract varies. And again, it's all kind of predicated on, because if you just think about the nuances of the business, it's pretty simple. Like, production costs are generally, as a general matter, offset by advertising revenue. And so then you just kind of dive into the distribution revenue. And so it was just a matter of, instead of kind of managing the ups and downs and the waves of what's going on in the marketplace, we were able to set the distribution market, and it determines what we can pay teams. And, listen, the company nor its stakeholders are going to underwrite unprofitable agreements.
Well, so let me ask you this way. Moving forward, do you think we are headed toward a world where, broadly speaking, teams are going to have to accept less money than they had been receiving from regional sports networks?
I think it all depends. I really think it's on a case-by-case basis. You have to remember, these deals are done at different times. Granted, we've just run the table on these 29 teams, but and markets are different. There are some markets, like for instance, the territory for the Atlanta Braves is massive. The territory for other teams isn't as massive. It all kind of depends. What we were able to do, and it's what we're really excited about, is in addition to stabilizing the MVPD marketplace, stabilizing our rights costs, we were able to expand the rights that we got from teams, whether we had them to begin with or not. And we think we've built by far the best mousetrap to monetize the rights digitally, as between our agreement with Amazon, but also our deal with FanDuel.
I've spoken to some of the league commissioners about the current state of RSNs. Broadly speaking, I would say they are displeased. They want something else. They want the rights back. They want a model that gives them more reach. Do you think that is a fair characterization of where the league's thinking is today?
I think it varies. Listen, going through what we went through, everybody in the ecosystem experienced high degrees of uncertainty. And that obviously includes the leagues and it obviously includes the teams. And you remember, this was like the ultimate annuity business for decades. And it went from a business of great certainty to a business of ultimate uncertainty in the context of a bankruptcy case. And look, where I think the leagues are aligned is they want, in the end, what's best for their teams. And I know that's obvious to all, but I don't think it's one size fits all in terms of how the leagues have thought about the RSN space on a go-forward basis.
So what model do you think is best for their teams? Is it a unified model where it kind of looks the same team to team? Because right now the RSN model, if you kind of go team by team, it's like every team has a different solution. Some use broadcast networks, some own their RSN, some are a part of an RSN group, some have split streaming rights from broadcast. What is the right model?
Look, in the end, these are the team's rights, right? These teams own these rights. And in the end, the best model for them is the model that drives the most value, economically and otherwise.
So you do think it may end up being with this sort of fractured team-by-team model rather than a universal
No,
solution?
listen, I think the best model also includes aggregation, right? An aggregated destination for fans and markets.
So describe to me what you mean by aggregation, meaning that I buy something and I have access to all of the teams in my region?
Yeah.
That's what you're thinking?
Well, I think about it in a couple of different ways. One, yes, having a 12-month destination for regional sports fans is just logically more valuable than having a 6-month destination, where for 6 months there isn't anything for the fans to experience. So I mean it that way.
So that requires partnership among the media companies that currently own the rights, or a whole new model?
No, it just requires partnership amongst us and our various team partners as it relates to the markets that we operate in. Or, look, it requires a market aggregator for the team rights, of which we are and of which other companies are.
And has anyone raised their hand and said, we want to do that to you?
No, we're doing it ourselves.
Well, right, but you're only doing it for a small portion of the teams.
Right, so that's kind of where I'm going. Aggregation for us, we have 16 networks today. Scale matters in terms of how many markets you're in. It matters in a couple of different ways. It matters from an advertising standpoint. It matters in terms of value you bring to distributors. It matters in terms of driving direct to consumer. And so one way for us to scale the business is obviously to get into other markets. And look, we think we've built the most valuable economic engine for these teams. And if those teams or other RSNs are interested in having a conversation, as of 12 days ago, we're open for business.
Gotcha. So again, just to put a bow on this, your thinking is you own the baseball team in pick a city, and you're able to have partnership conversations, perhaps with a centralized aggregator that says, you pay X amount of money and you get your baseball team, your basketball team, your hockey team for this price.
Yeah, it's a little bit different. It's a little bit nuanced. We play the role of aggregator in our markets today relative to the teams that we have under contract from a rights standpoint, okay? So if you look at the recent announcement, we just cut an extension with the Reds. And Reds, people in the Reds service area are gonna have access to the Reds, they're gonna have access to the Blue Jackets, and they're gonna have access in some areas to the Cavaliers. And that's the value proposition that we bring to fans in those markets.
Right.
And we convey those rights really in two different ways. One is we sell them wholesale to multi-channel distributors, and the other is we sell directly to the fan in a couple of different ways.
That's because you own the rights to those teams, that what you're advocating is in the areas where you may only own the rights to one team and there are other teams where other companies own their rights per market, perhaps you guys, through a centralized aggregator, can offer a new product that does not exist today that would allow fans to get all access to the teams together.
Yeah, if there are other teams in the market that we don't have, really adding those teams, it requires us doing a rights deal with those teams and adding those teams to our portfolio, as we've done, as we've reconstituted
Well, no, but
the
I guess what I'm saying is it doesn't necessarily require you adding them to your portfolio if you're able to do a partnership deal with someone else.
Yeah, exactly. Listen, another way that we could do business with these teams out of our markets is like, when I first arrived on the scene, when it came to our direct-to-consumer product, we were outsourcing everything from a product and technology standpoint. We brought all that in-house. And so, of course, yeah, we could go to teams outside of our market and partner with them on their direct-to-consumer product and offer them a full-scale white label solution. It's actually one of the ways that we're looking at scaling the business, yes.
Okay. Another trend that we see right now among the pay TV distributors is there are some that clearly are interested in tiering regional sports networks. So for years and years, RSNs have been part of your standard cable bundle. Now these pay TV operators want to make consumers pay more money to get the RSNs because they tend to be expensive and they have sort of specific audiences. Is this a fait accompli? Is this there's kind of nothing you guys can do about this? And this
I think we're on the other end of it. I'll go back to what I was talking about earlier. In order for the company to emerge from bankruptcy, once we had a committed group of creditors, our next step was to figure out what the art of the possible is within the MVPD distribution space. And we did that. And as part of that, Comcast re-tiered our services at the end of the day. And so we think, as it relates to how distributors are thinking about the space for the foreseeable future, we're out on the other end of it. I think the other point that I made, which is really important, is that we then, after we figured out what the art of the possible is relative to the distribution marketplace, is cut our rights deals based on how we were forecasting that marketplace. And is there variability? Yes, the variability is subscriber churn. But our economic model has already contemplated the re-tiering that exists in the marketplace.
All right, I want to get back to what the company looks like today. So you have still a fair amount of teams within the portfolio. How many of those teams' rights do you have beyond the 2025 season?
I would say at least 75%.
Okay. You guys have made sort of a company decision, perhaps some of it forced on you, but maybe some of it not, to rebrand here, right? So Diamond, you mentioned, is no longer called Diamond.
The artist formerly known as. I like that.
Main Street Sports. Also, Bally is not the name of the sports group anymore. It's now FanDuel. How did that sponsorship deal come?
Yeah, so we issued an RFP to the marketplace. We talked to any number of companies. We talked to betting companies. We talked to digital media companies. And based on a couple of different factors, FanDuel just rose to the top very, very quickly. Number one, they're a very sophisticated marketing company. Number two, their brand equity is off the charts. Number three, listen, and this matters, and it probably doesn't get reported as much as it should. Like, there's just a fit between the two companies. We've known the executives at FanDuel for a long time. We're like-minded in terms of how we operate. So alignment is key. But that came about through an RFP process, and we honestly couldn't be more pleased with. They're incredible partners. As it relates to the shift from Diamond, that was the name given to the company from the prior administration. And look, we felt it important to rename the company to kind of connote a fresh start. And we coalesced around Main Street, I think for obvious reasons. Like we're a local business and every town has a Main Street as far as we can tell.
Clearly you guys are in a much better position from a capital structure standpoint on a go-forward basis. I guess maybe skeptics would say, well, yeah, that might be true, but the underlying foundations of the business haven't changed. So it's still a very difficult time to be an operator of regional sports networks because it's still very clear that the amount of subscribers on the cable side is going to decrease and it's hard to make them up on the streaming side. What is your counter to that?
Yeah, so again, I'll go back to what I said in terms of this is a unique situation in terms of what we've been through for a lot of reasons. At the top of that list is our ability to totally reset and revamp the business, which enabled us to account for subscriber churn. And so we have subscriber churn forecasted in our business model. It's accounted for in terms of how we're managing the economics of the business. We've been conservative in those assessments in terms of what churn will be, and nobody knows what it's going to be. We do think at some point, just based on the law of numbers, that it does kind of subside in a way, but we've been cautious, right? Because you have to think about this from our stakeholder perspective. It's not just that they converted debt into equity. They invested hundreds of millions of dollars into this business. And so, we obviously spent a lot of time on, as best we can, managing variables like churn. We have, in addition to that, we have 85% of our distribution revenue locked up for the next 3 baseball seasons. We have some markets that have, 100% of their distribution revenue locked up for the next 3 baseball seasons. That unto itself is an anomaly in the regional sports network business. Distributors are doing short-term deals. And in addition to that, like on the direct-to-consumer piece, here's kind of what you need to believe for this company to succeed, to build value for its stakeholders. You have a pool of subscribers that don't subscribe to multi-channel television, and you have to believe that over a period of time, over a few years, that we can get high single-digit penetration. And then, oh, by the way, what we've done is we've also rebuilt the business internally in terms of there's a cost structure that needed to be overhauled. They were businesses that were being run like fiefdoms, individual businesses. Like, we need to take advantage of our scale internally, and we believe that there are other opportunities out there, and we're already seeing those opportunities. Like our ad sales business, particularly on the digital side of things, is growing double digits.
But does the price have to come down on the streaming side? Like, is it just out of whack to be like, I'm paying $30 to watch a couple of my teams, and I'm paying 3 times less to watch the entire Netflix catalog?
Yeah, so for us, we sell our direct-to-consumer product for $19.99 a month, and there are different promotions out there. For instance, we have a promotion with FanDuel. If you make a bet, you get 3 months free, right? So it all kind of averages out. We have the ability to go lower, and we're going to test different price points. Absolutely. And like geography matters too, Alex. Like if you live in the city, that's different than if you live in the outer edges of the service area of the network. We have the ability, based on the capability we've built that we own, to test all of those price points, and we will. And in addition to that, we have 2 great partners in Amazon and FanDuel. A huge focus of the company is to execute on other third-party partnerships that are going to drive our direct-to-consumer business and our advertising business.
Last question. I realize you guys just emerged out of bankruptcy, but in your mind, as you look forward with this new company, does it make sense as a standalone company as you guys are currently today, or does it make more sense as part of a different entity?
I don't know. I think time's going to tell. We've just emerged from bankruptcy. We've hired an incredibly talented executive team, and we are focused on growing this business, maniacally focused on growing this business. And we are turning over every rock on a daily basis to figure out how to scale this business, while at the same time having huge courage in our convictions, real optimism about what we want to accomplish in the future. And we think we've got the scale relative to the rights portfolio and the right partnerships, and set up to have even more partnerships to build something of substance that's centered around, again, let's go back to where we started, regional professional sports rights. And there is no more powerful connection to a sports fan than the connection that they have with the local teams that they love.
Appreciate the time, David.
Thank you very
Thank
much.
you.